look at page 59. Now we're gonna see a question on, you can say it's tax planning, okay, but it doesn't really involve any difficult planning arrangement. It's actually your understanding of the tax. So this kind of question is very common in P6. All right, so it's based on different area of your study that they form a question. Okay. Now, if you see the requirement, they want us to prepare a letter to the managers of new co to the managers from new co, tax agent, high and low. So you are the agent to this firm, and you're going to write to Newco, so the name must be correct, okay? So if not, then later your format marks, you're going to lose it. Now, based on the information given above, give an estimate supported with appropriately formatted computation. How much is the tax liability for the first year of assessment? So you're supposed to work out the tax com for the first year, and you need to state which year of assessment this is. Then number 2, explain your treatment for income tax purpose, the opening stock, machinery and plant for new co Sdn Bhd. Number 3, state the date by which new co is required to submit the first estimate of tax payable, the installment you need to pay, the date of the first installment, and the minimum requirement. So that's the admin part, okay? So this is where tax admin will also come out in P6, okay? The professional marks will be awarded in part A for your formatting and the language and stuff like that, okay? So B, now they say, state and explain how the overall efficiency could have been improved. The efficiency could have been improved if the bank loan of 4 million had been arranged as a loan to new co than to the shareholder themselves. So if you give 4 million loan to new co and not to the shareholder, so you must explain the implication, okay? Now let's read the story and see what is this all about. Now it says that Ironside is an old established manufacturing company which has fallen on hard times. Now an offer has been put forward by 3 members of the present management team, the managers, who presently own no shares in the company. So they tell you that they have no share, but they will buy out the business. Okay, they're gonna buy out the business. Now they're gonna buy the business. It's not they're not gonna buy the share, so it's different. Okay, now we'll learn this again towards the end about acquisition of business or acquisition of share. Usually, what are the differences? But actually, you learn all these things already. Okay, so towards the end, it's just to summarize again. Now, so if you're gonna buy business, means you're gonna buy one by one those assets that you want. You pick it up. Okay. Now the offer has been agreed by the board of director. So the offer is 5 million, for which the new owner will buy. Now they're gonna buy Okay, this is the iron side, the seller, okay, the disposer. Now the residual value, and this is the price they offer. So the manager offer 1.5 million to buy the heavy machine that has no more residual value. Okay, now then they will offer 500,000 to buy the general machine that there's still residual value of 300,000. They will offer 3 million to buy the stock that the cost to Ironside 2 million. Okay, now the following information is also available. Now Ironside will continue to own the freehold factory from which the business has been conducted, and they will rent it to the new owner for 750,000 a year. The managers have negotiated a bank loan of 4 million, which will be used together with 1 million from their private resources, and they will inject 5 million ringgit into the ordinary share capital of Newco. So now they're going to have a new company called Newco. So the Newco will have 5 million capital, 1 million from their own resources, 4 million from a bank loan. Now they will inject all this into Newco, then they'll use the 5 million, which is the 5 million to pay for all these assets. So they're paying 5 million to Ironside for all these assets that they buy over from taking over the business. So 1st of July 2010 has been designated as the takeover date. Now, so this is actually issues about commencement of basis period. Okay, so we know that how to determine basis period, when will the business commence. Now usually if you are looking at trading service, we normally look at what? The date that you're available, you open to the public. Okay, now manufacturing, we say the commencement of the first process, but this is an existing business. So existing business, when you buy over, the commencement date is the takeover date. Okay, so the date of the takeover is the date you commence. Well, anyway, in this question there's only one date. You cannot be wrong. Can you see not? Okay, now they just give you 1st of July, so that has to be the date. What else can you use, right? Okay, now so this is the date of the commencement, just that you must explain. Okay, now the company intends to make up its account to 30th June. So if you start 1st July and you close 30th June, now this is an exact 12 months account. Okay, so in that case, this is an issue that you find you do not need to adjust basis period. Okay, so you just watch out for coming exam that you might get basis period. Where examiner added this to your syllabus. Okay, so the basis period and the change of accounting date. So maybe something like that. She might want to test you also. Okay, now so in that case, this will form the basis period for Newco, July till 30th June. Okay, come back. The new owners have produced the following profit projection for the first year. So they tell you that the sales is 15 million, the cost of sales is 10 million, and that has included the value of the stock you buy, the 3 million that you pay from Ironside. Now then they have rental 750, depreciation, other costs, director fee. So that's the net profits that we have over here. Okay, now so the first thing we need to do, now same thing, to produce the command you must have the estimate, right? So that's where the starting point is. Okay, now so as I say in the exam, the appendix is at the back, but here is in the class. So we do the computation first. Okay, right, so this is now you will have to produce the tax computation for Newco. Alright, and this is YA 2011. Now I just indicate the basis period for you. Okay, now as you can see, they given you a profit before tax, right, which is 3.4 million. So you're going to use P&L and then work out a tax com. Okay, now so that's the first part. The main marks are given on the tax com. Okay, now you try this for me. Actually 2 minutes or so you can get the answer. It's very simple. Just get me how much is the tax. Right, still stuck. The mind still clouded with a lot of things. Still think left, think right, what to do, right? Okay. Now, see, I've said from the last tutorial, when you do tax com, you start from basic. You must not look at the question and do the com. You must look at the com and ask what is in the question. Okay. Now, they've given you the P&L. Okay. So first of all is the stock issue. So do I need to do adjustment for stocks or not? Now, this is the knowledge you learn on trading stock. That when you seize a business, when the guy buy your stock over, that will use it as their stock in trade, the price that they pay will equals to your income and equals to their cost. That means there's no issue, there's no adjustment. Okay, so this is what happened in cessation. So the 3 million, no issue. Now, everything is here already. Okay, everything is here already. See, the rental is there. Alright, depreciation is there, other costs, director fee, all that. Okay, so the list of expenses that we see here, the only thing that is very obvious that you cannot claim is depreciation. Okay, so I see those in the front all adjusted this. You add back depreciation, 350. Now there's only one figure to add so far, so this become my adjusted income, 3750. Now here is where you pause and you ask yourself, so after adjusted income, normally what do I do? You must ask yourself, and you know that CA should come in, right? So if you know that there's a CA should come in, then you must now look back into the question and say, okay, where is the CA? Now the CA will be the assets you buy, because you bought this asset when you just start the business. You just start the new company, right? And you're going to buy the asset one, and these are the assets one, see? So now the issues is when you buy the asset, you must ask yourself, what are those adjustments do I need? For example, do you think that this is control transfer? So you must ask. So if this is control transfer, then I will look at what is the amount that they claim and how much do I claim. But then this is very, very clear that you don't own any shares in the company. Now when you don't own any shares, the issue of control doesn't arise in it. Okay? Now if it's control doesn't arise, the other one that can be control sale is if it's a gift. But this is not a gift. You buy one, can you see or not? Then the third one is if it's a scheme of amalgamation, which is not also one. So in that case, but anyway, you never learn amalgamation yet. You learn towards the end. Okay. So far, if you just look at control, there's no control. Now if there's no control, calculate CA the normal way. So you're just going to work out what's the CA over here. Okay, working one. Now, two assets that you buy, the heavy machine plus the general machine. Okay? So the qualifying plant expenditure is how much you pay for it. Now this is the first year, right? So you claim initial and annual, which is 20. Now heavy plant and machinery is 20. General plant machinery is 14. So I'll be getting 300,000, 100,000, 300, and 500, 14%, 70. So your RE will be 9. And 330. So 400k, 370, 770. Okay. Now, so CA will be 770. This brings me to statutory income. Okay. Now once you come to statutory, again, focus on the formula, not the question. You look at the question, you get carried away, then you start to see, don't know what figure to take. Don't look at the question first. You always go back to the basic. Now usually when I do tax com, I know after I finish business, I minus unabsorbed business loss. Well, that's definitely not in this case. First year, Okay, there's no unabsorbed business loss. Now then, do I have other business? Now, none. Then look for investment income. So if you look back into the P&L, there's nothing mentioned, right? I don't see interest or dividend or rental or anything. So there's no investment income. So if there's no investment income, then the statutory that we see here will immediately be aggregate. Fair enough. Aggregate, then usually what you do is you minus two things: losses, donation. See the P&L, I don't see donation as well, right? Fair enough. There's no donation. So if there's no donation, then the aggregate become total. Agree? And there's no deemed total income like dividend as well. So the total become chargeable. So now the last thing I need is to work out the tax. So what tax rate do I use? So in this case, I must ask whether this is a big or a small company. Now it's very obvious, right? They're going to start a company with 5 million capital. So 5 million capital means the company size is big. So 25%. So the estimated tax payable is 745. Okay, that's it. Follow up. Now, so stay the same approach in the coming exam. Every time if there's a tax com, don't start reading the question and say, what do I do? You cannot see one. You must look at the tax com formula. The formula must come out in your mind, and then you ask yourself, what's the next thing I want? Then go back to the question and look for it. Don't have, then ask yourself, do I need to compute? If yes, go on. Okay? Now that's how you should do it. If not, you have too many things in your mind. The question will cloud your mind. Then you cannot see. Okay? Right, so this is the first part. Now you've got your computation out. So what you're going to do is you're going to write the letter. So when you write the letter, you prepare a format. Please. Okay? So I just leave that for you. Okay or not? Just prepare a letter format. Now, so the more important thing that we want to see in the letter format is, of course, you must have a letter. That means you must have address. Okay? And then the important thing is, who are you? And who do you write to? Okay? So these are the two issues that they will mark. So first is, you are high and law. Okay? That's you. You're from this firm, so you're high and law. And you're writing to new co. Follow on? Okay. So I just put down the point. Alright, first of all, now they ask you the year of assessment. Okay? They ask you the year of assessment. Now, but you don't just say that, oh, your year of assessment is what? Because you're going to write to them. You just understand that I'm a consultant, so I must give you details. So I don't just say 2011. So I must explain to them, okay, number one, that you are taking over the business of Ironside. So business commences on the date of the takeover, i.e. 1st July 2010. You must let them know, okay? And when you close this account on 30th June 2011, it is an exact 12 months account where such period shall form the tax basis period for year of assessment 2011. Now you answer the question, tell them what they want. Okay, now then they say how much is the estimate. Now then you will say that we estimated that your tax liability is 745. Then refer to estimate appendix. Okay. Now, so please don't put 1, 2, 3 like that. Write paragraph because it's a letter. Okay. Now, so there's the first part that you need to explain. Okay. Number 2. Now, the second issue is they're talking about the stock and the machine. Now, if you can come up with the computation, then you definitely will know how you handle the stock. Okay. Now, so the issue with the stock. So Ironside is ceasing business. So at cessation, any stock disposed to another person whom is taking it as his stock in trade. Then the value disposed shall be gross business income to disposer and cost to acquirer. Now, that's the law. Don't need to quote section. Okay, so this is the issue. The issue is you highlighted that they are seizing. Okay, and when you seize, the law say that when you sell to any person that is taking it as stock in trade, you must buy back and use it as a stock, which is what they are doing. We are buying over the business one, so that's the point. Now, so once you have these two conditions, then whatever value that you sell, it will be an income to disposer, it will be a cost to acquirer. Okay, so in fact, if the examiner wants you to work out the tax estimate for Ironside also, probably you can do it, because when they sell the 3 million, the cost is 2 million, they made a profit of 1 million. Okay, now when they made a profit of 1 million, then they give you the value they sell for the machine, right? Then you can work out what is the BABC. So you can also estimate, but of course it's not in the question. I'm just telling you, if examiner want you to estimate, actually you still can do it. Okay. Now, so this is what happened to the stock. Now, besides the issue on the stock, then what's the issue on the machine? So, plant and machinery. Now, we need to explain to them that there's no control. All right. So the disposal is not subject to control because now managers do not own any shares of Ironside. So control issue doesn't apply anymore. You don't own the share. Okay. Then number 2 is not gift, is not scheme of amalgamation. Okay. Now, so if none of these, then you have no issue of control sale. Okay. Now, if there's no issue of control sale, then what will happen? Then whatever consideration paid by NewCo shall be the qualifying plant expenditure to claim CA. Now they only ask the implication to NewCo, so you don't have to tell about what happened to Ironside. Okay, so we just need to talk about NewCo. So NewCo, whatever consi paid will be the qualifying plant. Now that's why in the computation we've taken the 1.5 million and the 500,000. Can see or not? Okay. Now then you must explain, right? Because 2011 is the first year. Okay. So why 2011 is the first year of assessment that it is incurred? So you can claim initial as well as annual. That's the treatment. All right. Now we don't see issue like small value asset, short life asset. Then there's no explanation really that you need to say. Okay. So you just have to mention about what to claim. So if you think that in the exam you're very sharp, you know what to do, you got a lot of time, you want to go on, you say I want to talk about what rate to claim and so on, go ahead. Okay. Now that's on condition you got time, because you really don't know that to what extent the detailed examiner one. But it's just 4 mark. So if 4 mark, I look at this, I think it's more or less enough. Follow? Okay. Now this is number 2. Okay. Number 3. Now they are asking issues on tax admin. Okay. So this is issue about tax admin. Now first, when will you submit estimate? Now to new company, you submit estimate within 3 months from commencement. Agree? So if you know commencement is 1st of July, so 7, 8, 9. So by 30th September 2010. Now we stress on this word again. By is including. Okay? Including. Because don't write before. Before means you don't include 30th. And don't write on. Okay? So put by because it's including. Okay, number 2. Now what is the number of installments? Now the number of installment depends on the basis period, right? The number of installment will equals to your basis period. So since it's 12 months, so there will be 12 installment. Now the first payment is in the 6th month because you're new. Okay, so 6 months in this case will be when? So 7, 8, 9, 10, 11, 12. Okay, so in that case it will be in December, and latest due on the 10th of December. Now I say latest, so that means including the day before. Alright, so the latest is on the 10th of December. Now the amount of the installment will be 745 divided by 12, which comes to 62,083. Okay, number 4, they ask us what's the minimum requirement. Now we know that the estimate is minimum 85% of the last estimate or the last revise, but there's on condition you estimate before. So this is the first time you do it. If you say 85%, your answer is wrong already. Okay. Now because this is the first estimate, then there's no previous estimate. So really, there is no minimum. Okay, there is no minimum. But even though there's no minimum, you must not forget you're a consultant, right? So if you say no minimum, then the guy say, can I put 0? Yeah, you can put 0, but you must understand, your tax is 745. You put 0, you get penalty. Okay, so, so that's why you must tell him that although there's no minimum, but if your estimate is too low, penalty of underestimation can be imposed. Okay? Well, I'm not going to tell you how to derive that penalty because nothing in the question indicates. So I'm just giving you a warning that there is a penalty. Okay? Alright. So this is the first part. Okay? So that's on the first issue. Okay, now the second issue is your financing. So we look at part B. Now they ask us that how would the overall efficiency change if now the 4 million is taken by new co instead of the shareholder. Okay. Now the issue that we're going to see is what? Then new co will have 1 million paid up ordinary share capital, 4 million loan, which interest is payable. Now your share cap is 1 million. So a lot of students, the comment we get is they only talk about the loan interest. They have completely forgotten that when you take a loan of 4 million yourself, when your share cap turn 1 million, the size of the company from big now turn to small, and they miss this part. Okay, they only tell that you can claim deduction. Now you can't just get 8 marks for claiming deduction. Okay, so that's another issue that is hidden. You must pick it up. Okay, now so the first issue is the deduction of the interest. Now, if shareholders took the loan to invest in the share of NewCo, then it's very inefficient, right? Correct, not? Then all the interest expense arising will not get any tax deduction. Okay, agree or not? And the reason why you don't get deduction is very clear, right? Because the dividend that the company pay has to be single tier deal. It's a new company. You don't have section 108. You can't pay frank dividend. So the most is single tier. Even if it's not single tier, I give you exempt dividend, still there's no deduction, right? So you will not get deduction because the dividend paid by NewCo is single tier. So that's why the shareholders will lose out. Okay? Now, so if NewCo is to borrow the loan themselves, number one, when you borrow loan, then you know that deduction under 33(2) will come in. Can I claim deduction for interest? You must explain first. Can you claim deduction for interest? Okay. Now you find that the interest expense qualifies deduction because the loan borrow, okay, you either have laid on asset that will be used in the business or is employed in the business to produce business income. Now, so there's one issue already. So because you fulfill the requirement of the law, you can claim deduction. Alright? Because you're going to take the loan to buy what? Machine, buy stock. So all this is all 100% meant for the business. That's why in that case, deduction is given. Now then number 2, will there be section 33(2) or not? Now 33(2) is restriction, right? The restriction comes in on condition if you have investment. That means you must see whether NewCo themselves got buy property for rental, got buy share. Now so far we see none. They are just buying over the business for 5 million. So NewCo has no investment or given loan to others. Now, if you have no investment and you have not given loan to others, then there will be no interest restriction over the interest expense. You will get full deduction. Okay, so that's very efficient, right? Now that's in terms of the deduction of the interest law. Okay, in terms of the size of the company, now you will have to say that because at the beginning of the basis period for a year of assessment, your OSC is not exceeding 2.5 million ringgit. Now we don't really have a word called small company, so I just put in inverted comma. Okay, that is a small company that has several tax advantage. So what advantage as a small company do you enjoy? Now, first of all, the most obvious is your profit, fair enough. Now your tax rate is 20% for the first 500,000 XCI. See, right now your profit that we estimated just now, the income, is 2 million. Okay, even you charge the interest, you're still going to exceed 2 million. Yes, you know. So in that case, you will only see a saving of 5% times 500, which is 25k. Now we can quantify the impact, right? Because we look at the figure, you know it. Okay, so there's a 5% on the 500,000, which is 25k. Now then, number two, you will not require to submit tax estimate and pay installment as a small company for the first and the second year of assessment. But on condition the second year your capital remain not exceeding 2.5 million. Okay. Now, so this benefit to you is you can save your cash flow. Okay. So there's the advantage that you can save your cash flow. Now, number three, as a small company, if your authorized share capital is not paid up, so you must clarify correctly. Okay, so if the authorized share capital is not exceeding 2.5 million, you also can claim certain incorporation expenses, which in this case you definitely can't. Your paid up is 5 million, the authorized must exceed paid up. Okay, so this is the third issue. You can get deduction for incorporation expenses. Now, number four, you can claim CA on small value asset without a restriction of 10,000 per year. Okay, so these are the advantages. All right. Okay, so that's questions on various areas. These are questions very common in exam, because examiner will test and assess whether your overall understanding is there. Okay, all right. Now we move on and see another one. Okay, just turn a few pages to the back. Look at question 4. Question 4. So it's here 25 markers. Okay, so this part the examiner break down into different area. So you can see there's part A, B, part C. Okay, they're all 3 parts. But we look at first of all, there's a 14 marks question that they ask. Okay, what's the implication for employee A on each of the alternative scheme? So we are looking about implication to A, the employee. Okay. Now the marks will be 9 marks for the first scheme, 2 marks for the second scheme. So the big chunk of the explanation is the first scheme. Okay. Now number 2, state and explain the implication then to ABC for each of the alternative. So now they talk about ABC. Okay. Now see what's this thing all about. They say directors of ABC, a listed company, are considering a proposal to make the shares available to the worker free of cost. They want to give shares to their worker. So 2 possibilities have been put forward. Okay, number 1. Employees will be granted option to buy a specified number of shares at 1 ringgit per share within a period of 2 years from the date of the grant. So the exercise price is 1 ringgit. Now at the same time, participant will become entitled to a bonus equal to the price to be paid for the share, because they want to make it free for you. So they give you an option, then they give you a bonus. So the bonus they give you is 1 ringgit per share. That means once you get the bonus, you got the cash. They take the cash to buy the share. So the share becomes free to you. That's the idea. Okay. Payable at the time of exercising. Okay, the bonus is payable at the time of exercising, so that these funds can be used to pay the purchase price of the share. Okay, that's the first scheme. Okay, second scheme, employee will be given free of any payment the same number of share in the company as specified in scheme number 1. So you get a share for free. They straight away give it to you. Okay. Alright, now if the proposal is implemented, employee A will entitle to 10,000 shares with effect from 1st July 2010. That's the date. Now the market price will be 3 ringgit at the time of the grant of the option, or the date of the gift, whichever one you use. So it's just trying to tell you, scheme 1 or scheme 2, the market value is 3 ringgit. Now if granted the option, assume employee A will exercise the option on 1st July 2011. At the time the market price is expected to be 7 ringgit per share. Now in either case, employee A will sell the share on 1st January 2012, where the price is expected to be 10. Now whatever price you sell later, that's your issue already. It's a capital gain. Okay, so when you dispose them later, this is already a capital gain. So there's no tax implication. Alright, now so that's the first thing we're going to see. Alright, now first of all, okay, what is in scheme 1? Now scheme 1, employee is offered a share option scheme plus a cash bonus. Okay. Okay. Look at bonus. Now bonus is straightforward. It's monetary. Okay. It's already defined in 13.1a. It's a gain under 13.1a. This section must quote. Okay. Section 13.1 is required. So from we also don't know why the examiner always say like that, okay? Because if you look at teaching guide, they never say anything, but they always assume from the tradition, all the while in the past, student must be able to identify ABC, okay? So that's why you must know this. So you must tell me that the bonus is under 13.1a, okay? Now, then when will bonus be assessed? Now we know assess on receipt basis. So if the bonus is assessed on receipt basis and they mention to you what you're going to get it when you exercise, right? So ABC will pay on exercising of the option. So employee A is receiving the bonus on 1st July 2011. So the entire 10,000 ringgit is 2011. Okay, now so we want y'all to mention 13.1a. You mention receipt. Then you mention the year of assessment. Okay, now these are the main thing that we want to see. Okay, or else then how they explain the treatment, right? Okay, then you talk about the share option. Now, option is a perquisite. So you must use this word, okay? Option is a perquisite. So any form of benefit that there is a monetary gain to you, okay, is always called a perquisite. Like option, like employer pay your income tax, these are called perquisite. Okay, so not like employer give you a watch, that's called a perquisite. Okay, so just remember this is a perquisite. Now, which is also accessible under 13.1a. Okay, then you must explain that the value of gain to be assessed is derived as, now, so put in the formula. So the aspect you explain, right? So you must explain. Now the amount, I just work it out here, so I don't have to turn here and there. We take the market value when option is exercisable, market value when option is exercised. Okay, or you can say that it's assessed derived as follow, then you show them like that also can. Okay, now so in this case the figure that we see is what? 3 ringgit. Alright, 3 ringgit. Assuming the grant is the exercise. That's why I told you all the while in the past, we just assume grant is exercisable. Okay, but because now there's a new public ruling, that's why I mentioned clearly to you, be careful. Maybe I will grant you the option today, but you can only exercise 6 months later. So the market value is exercisable. Okay, now so like here there's only one price, 3 ringgit. Now but when you exercise, the time is 7. So we take the lower, which is 3. exercise price is 1. Okay, so the gain is 2 ringgit times 10,000. So assessable gain is 20,000 ringgit. Now when will option be assessed? Now again, the law say is when you exercise, right? So you will assess when option is exercised, i.e. is in Y 2011. This is scheme 1. Now scheme 2 is what? They say they just give the share to you. That's it. Okay. Now if you follow scheme 2, again the free share will be a form of perquisite. Because the shares you obtain, you can sell and you raise it as a cash and you keep the money. Okay. So it's a form of perquisite. So again, it's still assessed in 13(1)(a). So the value of the share upon the gift is made is the value of the gain. So the gain will be 3 ringgit times 10,000 share. So that's 30,000. Now this is not option, is not bonus. So the basis of assessment is when you're entitled. Okay. So in this case, they say that they will pass it on to you in 2010, right? So the employee is given the share in 2010. So you assess it in 2010. Okay, now the basis is called receivable. That if you're entitled to it, then when you become entitled, you become accessible. Alright? Now, so that's the first part. Okay, so this is what we see for worker. So now they ask you what is the implication to the company. Now the implication to company, tax implication, then we must see, will there be any cost arising? Okay, now if you talk about giving a bonus, number 2 to ABC. Now bonus is deductible as a staff cost. Okay, but you must understand that the basis of assessing the worker is 2011 because it's receipt basis, the law changed it. But when it comes to deduction, you will follow a normal deduction rule that this bonus is deductible when it is incurred, and incurred to us is become payable, right? i.e. is in 2010. Okay, now so if you say 2010 July, 1st July 2010, then it will be deductible in the relevant basis period for the year of assessment, where 1st July 2010 fall under. Now the question never say the year end, so I cannot say which YA. You say YA, you are wrong already, okay? You don't say, oh, deduct in Y 2010, because you don't know the year end. If my year end is 30th June, then the deduction is 2011. If my year end is 30th September, then it's 2010. So that's why you must be very careful, okay? Don't put the YA. Put YA, your answer is wrong, okay? You must mention the date that is considered payable here, so you claim in the relevant YA. Now this is the bonus. Now the share option that you offer, there is no cost. Okay, so you just give a free option that you can buy the share, then after that you raise the share. Now there's no cost. Okay. Now probably the only cost you incur is the cost of offering this kind of option to you. Okay, so which can be taken as part of the start cost, but it's very minimal. So the option itself got no cost, so there's no implication. Now this is the first scheme. Okay, if you follow the second scheme, now again they say give you the free share. Now this one the answer must modify a bit lah. Okay, now where do you get the free share? If you're just going to raise fresh share and give it to the worker, then again there's no implication. Okay, so if you're going to issue new share and give to employee, then again there's no implication because there's no cost. Now, but if you follow the new law that section 34 apply now, 34D I think, okay, that cost of treasury share, that if you give it to the worker or you sell it to the worker, you can claim a deduction. Okay, now so if ABC acquired treasury share and transfer them to employee A, then the cost of treasury share will be given deduction. Okay, now but before deduction you will need to offset any surplus brought forward previously. Okay, now the surplus is when employee pay more than your cost. Okay, so this is the case that employee pay more than the cost. Now whether go or not we don't know. Maybe you buy the share last time very cheap. Probably you buy at 2 ringgit. Okay, now you transfer, the worker paid 250, then there's a surplus. Okay, now so you might have a surplus previously. If you have, you will have to offset the surplus. Okay, and then you will claim when shares are transferred to the employee. Okay, so there's the extra thing that I added on. So these are things you can't see from the answer because the law changed. Okay, so that's the issue about treasury share. Alright, so that's first part A. Okay, look at B then. Now B is 3 marks requirement relating to venture company, okay, VC and VCC. Okay, now part B they ask number 1. Now state any one of the 2 basic requirements for a company to be treated as a venture company. Okay, then number 2, state any 2 of the activities in which venture company must be involved when they want to utilize seed, startup or early stage financing. Okay, now see we said before VC and VCC. Now VCC is the capital provider, okay? The capital provider. So the government give incentive for VCC, but you must have condition to fulfill, okay? Now we say that VC by itself, they already enjoy incentive. For example, like they can apply Pioneer ITA. So now first part examiner asks is this. Okay, examiner say number 1. Now any one of the 2 basic requirements that you can be treated as venture company. Okay, now you must be incorporated in Malaysia. That's one of the requirements. Okay, number 2 is you resident. So first one, it is tax resident in Malaysia. Just one, just finish it. Basic condition. Okay. Now then number 2. Now say any 2 of the activities that you qualify. Now because to enjoy incentive, you must qualify to apply incentive. So one of it we say before, for example, you involve in promoted activity. So number 1, activities promoted under PIA. Okay, so if your business involved in promoted activities. Okay, now for example, technology based activity that is listed under Nasdaq market. So two of it. Okay, in the notes you can see we listed there are 4. Okay, now for example, if you activities under the MSc grant, all right, now all these are the basic condition. So there's 3 mark. So you just give any 2, and this one there's a 3 mark. Okay, now just turn to the back. So part number 3. Now the third part, they ask us the 6 marks requirement that says like this. Now based on the information given above, compute Ahmad Mizan's total income after relief for his investment in risky venture for the years affected by his claim, clearly indicating the years affected. Now, so we know this is the other incentive, right? Now, one incentive is for VCC, that they provide capital. Now, the other incentive is we say that you can be an investor, that you are not VCC, you can claim deduction. Okay, you can claim deduction. Alright, so deduction is claimed on the cost of your investment, and then you claim when you dispose. Alright, now we read the question, see what they say. Okay, it says that in September 2006, Mizan applied for and was issued 15,000 shares in Risky, a company classified as venture company, at the cost of 1 ringgit. Now this is how much he subscribed. He paid 1 ringgit. Now September 2006, he subscribed. He sold 3 ringgit in November 2008. So you exceed the 2-year holding already. Okay, no issue. Because if not exceeding 2 year, deduction is not given. Correct or not? So that's why in this case, okay. Okay, having obtained a certificate from the Securities Commission confirming his entitlement, Ahmad Mizan now wants to claim any tax relief due to him. Now before the claim, he has declared all this 2.7, 8 and 2.9. Now he disposed in 2.8. You claim when you dispose, not when you buy. Okay, but anyway, you have no other choice. You buy in 06, examiner give you 7, 8, 9. They understood already lah. You must know where to claim. Okay. Now having they have the business adjusted income, CA, then there's also rental. That's all. Okay. Now so you're just gonna work out the year that affects him. Claim when Ahmad disposes the shares of the VC. So it's in Y08. Okay. Now, adjusted income as given is 10,000. The cost of shares in VC is 15,000. So your adjusted income is new already. Then you have a current year business loss 5,000. Now we have a CA of 8,000. So in that case, you will not be able to get CA, right? So the statutory income is new. Now again, normal tax com is after this. If you have other business, you put it in. Now I don't see any other business. Then you must ask, do you have unabsorbed business loss? Now again, I don't see, but maybe, I don't know, maybe after the current year loss, I might have unabsorbed loss. You might lah, I don't know, okay? So if like that, you can leave lines in your answer. So in case if got for the next year, you fill it in, okay? Now, so then we have your 4D rental income. Now the statutory is 45. Okay, so 45, then aggregate is 45,000. Now 45,000 you minus current year business loss 5,000. So total is 40. Now remember, this is an individual. Question only say work until total lah. If the question say work until chargeable, then please claim relief lor. Because you know in P6 very rare you get comprehensive personal tax question. So you get used to forget about relief. Then after you come to total, it straight say it's chargeable. So in case if examiner say I want chargeable, then you must remember there's a relief. Okay. Now in this case the question is not asking. Now so this is what happened to 2008. Now it affects my 2008. Then it has to affect 2009 already, because the CA is being carried forward. Okay. So in that case, it affects 2009. So you indicated the year already. Okay. Now, so the adjusted income is 40. I should write here. Never mind. Okay. 40. No adjustment already. Never mind. Okay. Just write 40. Now last year's CA was 8,000. So 8,000 we carry forward together with 5. Then we have 13. So 27. Okay. Now the rental income is 25. So we have 52. So the total income is 52. Okay, that's it. Okay, now look at part C. So this one, examiner is asking a simple theory on the share option and calculating accommodation. Alright. The examiner say that with effect from YA 2009, any gross income derived by individual from share option is disregarded when you determine benefit from living accommodation. Now what is this? So they ask you to explain the significance of the change. Now first of all, you must know in which way that it affects us. Okay. Now employee receiving living accommodation benefit, the gain is derived based on the lower of 13% times 13(1)(a) gain, or the defined value of the accommodation. Now that's how the formula is derived. Okay. Now, however, the law has specifically excluded the gain of share option from the 13(1)(a) value for purpose of applying the formula above. Now it's only when you want to find the lower of 30% that time you take up. Okay, so we said that before. Alright. Now the logic behind why they do that is because they find that, because in the past option is assessed when it's receivable. That means you can receive you entitled to option maybe in 2010. You exercise in 2013. But last time we go back and assess in 2010. But there's a revision. So the government find it's tedious. That's why they change it. So now they say we just assess when you buy. So when you exercise 2013, you put it in. But you will give worker a shock to the income. Because all of a sudden you exercise, the gain push up the 13(1)(a), then suddenly the living accommodation value can also be inflated. Okay, so the reason why they do that is to prevent that. Okay, so this is to prevent a sudden rise in your 13(1)(a) value and then distort the value of living accommodation to be assessed to tax. Now, so you should also understand that this will not apply to all the worker, right? Because not all the worker uses the formula. So we mentioned before there's one particular category that they don't apply, which is the director side, right? Okay, so that's why you have to clearly indicate that this doesn't affect. This has no impact to non-service director of controlled company. Okay, as the value of living accommodation is based on the DV. Okay, so you don't use the 30% or 1A, so there's no issue already. Okay. Right, we take a short break. Come back, then we continue.